Hey, good evening, everyone, and thank you for taking our time to join this refresher uh, program this evening. Um, Please, I would like for you to confirm if you can hear my voice and you can see my screen. If you can hear my
Prof,
voice, you
good
can
evening.
just unmute
I
and
can hear
confirm.
your, I can hear your voice.
Okay, perfect.
Can see your screen.
Okay, thank you very much.
I can hear
All
your
right.
voice and see us perfectly.
Okay. Okay, thanks. Okay, so we'll just go straight into the class, and as many that will join, as we progress, fine. I know we might not have a lot of persons join because the information came, at a short notice. But I mean, this is what we do, right? So, for all of you that have gone through my class, I mean, you understand the way it works. Okay, usually the best time for me is Sunday, 8 p.m., except first Sunday of the month. Because of my tight schedule, I try to manage my time just to be able to ensure I'm able to communicate to you guys, of happenings in the market. So today's class is just going to be a review class. And while we take on this class, I want us to all ensure that our microphone remain muted except you needed to speak. And if you need to speak, you can just raise off your hand. You can always stop me for clarification. Then, if you have any question, you can also use the chat box. Okay. And one thing that is critical is you need to ensure that your background is free of noise, while you speak, so that we can all get clearly what you are saying. So these are just the ground rules. So we are going to delve into the business of the day, which is trying to understand in detail or with a better approach on how we can take advantage of the market. Now the market is a very big, or I put it, let me say an ocean, a big ocean that never dries. You all know that as we speak today, the biggest financial market in the world is the forex market. That's the biggest. The stock market does not even come close to the forex market. The stock market is about the second biggest financial market in the world, but it doesn't even come close to what the forex market does. So that tells you there's a lot of liquidity, that are exchanging hands in the forex market. And as a result of that, you as a person, you want to be absolutely sure, or you want to know that your decision, to trade is accurate, or whatever you are relying on as information to trade is absolutely correct, so that you don't get into the trade and then you are struggling with the trade. I mean, in the course of our lecture, I did mention to you guys that champion traders, they win their trade first on paper before they go into the trade. And also, I also remember telling you about the expression of one of the Japanese soldiers, Su, that said that we win the war first before we engage the first shot. So what am I trying to say? I mean, there's a reason, or there's a key requirement for preparation. So you need to be prepared. We've covered a lot of models, in the course of this program. And I'm sure for those of you that, consistently stayed, started and, ended, you have a glimpse of what it takes to trade in the forex market. What you are seeing, the screen you are seeing right now, is a typical forex. chart. And I've decided to show you the monthly chart, the weekly chart, the daily chart, the 4-hour chart, and the 1-hour chart. I can go ahead to include the 30 minutes chart, the 15 minutes chart, the 5-minute chart, and the 1-minute chart. This is on the MT4 space. Okay, so for MT4, and you need to understand this as well. Remember, MT4 is just a tool, okay? And when I teach people, I liken the MT4 and the MT5 to the tools and apparatus that the farmer, you know, the farmer that goes to farm, it requires some tools to work, maybe cutlass, hoe, axe, you know. So that's the way the MT4 is. And it's the same for the banker who works with pen, software, paper, you know, these are tools that I use to work. So it's the same thing with MT4. So the MT4 and the MT5, they are your access, you know, to the forex market to trade. So it is imperative that any tool you are going to use to execute your job, it is good you understand that too. I don't know if you guys agree with me. It is good and it is key that you understand how to use that tool. You cannot be a soldier, you cannot be, you know, a military person, and you are going to a battlefront and you have a gun in your hand and you don't know how to operate it. Trust me, it's a disaster. Okay. So that's the same thing here. If you know all the knowledge, if you have all the understanding, all the wisdom to trade, and you cannot navigate the MT4 platform, it's a disaster. Okay. And what does it take to navigate the MT4 platform? Very simple. Like you do every other software, Microsoft Word, Microsoft Excel, PowerPoint, the same way you know how to use them. That's the same way you should know how to use your MetaTrader 4 and MetaTrader 5 terminals. Even if you don't know how to use them, I'm sure they have a help file like you have here. This is a help file. You can come to this help file, help topics, and you can do a training by yourself. If that is too cumbersome for you to follow, you can just head to YouTube and type MetaTrader 4, how to use MetaTrader 4, and you're going to see a lot of video pop up for you to review. Now, it is very important, and I'm stressing it. It's not a topic that I teach, right? I don't teach it as a topic because there's a whole lot that is involved. So you, as a person or as a trader, you need to take your time to go and study the trading channel that you are using. Now, maybe because of the broker that you are using, the broker does not allow MT4 or MT5. There are other trading software like the Ninja Trader, the C Trader. There are a lot of online based trading software that you can use. Trading View is one of them. Smart Trader is one of them. All this software, they have one underlying principle, just one underlying principle. Okay. And that underlying principle is that you are able to look at the software and you see how the candles are emanating, how they are forming, how they are opening and how they are closing. It's just basically the same thing. Okay. And also, I want you to understand that in forex trading, it's very difficult, for you to be scammed. What do I mean by that? GBP USD in Nigeria is GBP USD everywhere in the world. The same thing. Okay. You cannot see. So if I'm looking at this trade now, this is the price. This is the price of USD CHF. This is the current price. What it means is that I need this amount of CHF to get one USD. Remember when we started, we talked about the base currency and the quote currency. The base currency is the first currency in the pair. So when you see USD CHF, this first currency is called the base currency. This second currency is called the quote currency. Now, you need a particular quantity of the quote currency to get 1 unit of the base currency. So as we speak right now, I need 0.86452 CHF, that is the Swiss franc. I need this amount to get $1. What does that tell you? If you look at this value, if I need this value, to get $1. What's the implication? Does it mean that the US dollar is stronger than the Swiss franc, or the Swiss franc is stronger than the US dollar? Somebody tell me. From this information that we have here now, do you think the US dollar is stronger than the Swiss franc, or the Swiss franc is stronger than the US dollar?
What's the value of the Swiss dollar again?
Let me zoom this out. Look at it here. 0.
Okay.
0.86452. This value is equivalent to $1. You need
It means
this
the Swiss dollar,
The,
the
to get.
Swiss dollar is higher.
no, the pounds, the dollars is higher than the pounds because the dollars is the base currency. The other one is the quote currency. There's $1.
Wait. Listen. You are jumping too fast. This is CHF. This is not GBP. Okay. This is US dollar and CHF. CHF is Switzerland currency. Okay. And from this screen, this is what you are seeing now is the reality. That is to say, this is the officially approved exchange rate between the United States dollar and the Swiss franc. This is the officially approved exchange rate. Okay. Now, if you look at this value here, 0.86452, because the Swiss franc is the quote currency, it means you need this quantity of Swiss franc to get $1. So my question is,
Oh, that makes sense now.
no, so
Makes
my
sense now.
question is,
Yeah.
the US dollar, is it stronger than the Swiss franc, or the Swiss franc is
No.
stronger than the US dollar?
In this case, I think the Swiss franc is stronger than the US dollar because
Yeah,
you
the
need,
Swiss franc.
yeah,
I
it
agree
needs
with you.
less,
You're right.
yeah.
Okay, perfect. So very correct. Okay, because I need lesser quantity of the Swiss franc to get $1. It means the Swiss franc is higher in value than the US dollar. Even though the US dollar is the base currency, it doesn't matter. Okay, if I switch this chart to say GBP USD, look at GBP USD. Now this is Great British Pound versus the US dollar. Now I need 1.30472 US dollar to get 1 British pounds. So, in your opinion, which is stronger, the British pounds or the US dollar?
USD. The USD is stronger than the British pound. So you need less USD to get 1 British pound.
No, I need more USD. Look at it,
Yeah, you need more USD because
1.304
this is 0.
and
Yeah,
1. Which
you
one
need
is
more
higher?
USD to get.
I need
Yeah.
more USD
Oh, is
to
it
get,
1 point? I thought it was 0 point something.
no, 1 point. Look, can you see my screen?
It's a bit very small. I can't really make out.
This one cannot be zoomed. It cannot be
Okay.
increased. It cannot be
Okay, that
increased
makes
further.
sense. Sorry, I jumped into it. You're right. You're distracting me. Yeah, go ahead. I understand.
Okay, so you need more of the US dollar to get the
British
Great British pounds. So in effect, it means that the Great British pounds is stronger than the
stronger.
US dollar. Okay. If I had needed less of the US dollar to get the Great British pounds, then you can say that the US dollar is stronger than the GBP. Okay, so that's just food for thought. So I mean, just for you to understand, what is happening in the market. Now you want to trade. See, there's a way you will trade. and most time you can actually trade without losing. Okay, and that is when you like sometimes a lot of time that I trade and maybe I lose, trust me, is because I didn't wait, enough to make the right decision. And when I enter a trade and that trade is going against me, and I looked at it and I discovered that my decision was wrong, immediately I will close that trade and wait for another opportunity to trade. So in the forex market, one way you manage your emotion is for you to know exactly what to do when the market is going against you. Now, you were told that you need to use a lot size that fits the size of your capital. Whatever is your capital, whatever is the balance, you should not over leverage. You should not take, should not take unnecessarily big lots. Because when you take those unnecessary big lots, this market, even though this market is going up as it is from here, you can see that this market is going up, right? If you look at the USD CHF, even though this market is going up, you can see there are pullbacks. Pullback. This is a pullback. This is a pullback. This is a pullback. Okay. This is a pullback. And this is also a pullback. You can see there are places where the market pull back, right? And as we speak, the market is also pulling back again right now. Okay. Now, if you enter this market because you saw this big candle and then you come and buy, yeah, and all of a sudden the market decides to start pulling back, if your lot size is 0.01, you may not bother too much. You may be able to take the hit and probably put your stop loss below this swing low, right? But if you are using a higher lot, and then at this point you are seeing maybe minus $2,000, it is natural that you want to close that trade. And then after closing the trade, the next thing you see is that the market goes in your favor. It's just like the analysis I gave to you guys last week, and I said, close the trade because Bitcoin analysis has failed. Did you see what the market did later? After closing that trade, the market came back midnight the next day and then run in my favor. And that market is still buying it now as we speak. Okay. So now I decided to close that trade because I've used some lot size, as compared to my account capital that I cannot hold. Okay. But if there's somebody here that didn't close, based on what I said, close, that person will be in profit right now. You understand? That person will be in profit. So it's important you know the place where you are entering the market from. Very, very important. Okay. Then the last time we met, I did talk about um um I did talk about the baby pips and the market make, and how the market snapshot will help you in making your decision to trade. Okay. And of course, I shared this, with you guys before now, and I try to explain, why what you see is the way it is. Now, this is more like an indicator, right? There are tools behind the scene that help them to make this decision that they are projected to you. This is more like the output, okay, but they are input, and those inputs comes in the form of moving average, oscillators, basically indicators. Okay, so those indicators, the way they work, let me show you the way the one of TradingView works so that you will understand it better. So if you come to TradingView, okay, and TradingView, okay, so let's see. Okay, so let's just take major pairs. Okay, so major pairs, major currency pairs. Okay, so let's see. This is major currency pairs. So let's take. I didn't just the major. Sorry. I took minor, major. Currency indices. Okay, so let's just take the indices. Okay, so these are the various major currency in the world. There are 8 in number. 1, 2, 3, 4, 5, 6, 7, 8, 9. Now they've added let me see, Australian dollar, Swiss franc. Let me see the new one. US dollar, Euro, British pound, Swiss franc, Japanese yen, Canadian dollar, Australian dollar, New Zealand. Okay. Okay, so they added Canadian dollar, they added uh uh Canadian dollar, they added New Zealand dollar. So usually it was 7 before, and as of 2017 it was 7, and then in 2018 they added New Zealand dollar to it. And recently, this is just recently, I think it should be some few days ago, that they added this Canadian dollar now. So now we have 9 major, right? 1, 2, 3, 4, 5, 6, 7, okay, 8. 8 major currency pairs. So this currency that you see, these are like the currency that drives the world. These are the currency that controls the business affair of the world. Okay. So out of this currency, we now form, I can use this one alone by saying US dollar this, US dollar this, US dollar this, US dollar this. I will have like 7 pairs. If I do it from this one, I'll have another 7. So by the time I do all this, I will have close to like 28 pairs, to deal with. Now, if I open this pair, this is US dollar, okay? This is the US dollar alone. This is the US dollar index. So if I open this US dollar and I go to, this is just an overview of the chart over the years. Okay, you can zoom it to do more analysis on it, but then I just want to show you something behind the scene. So if you come here, you click on these technicals. When you click on technical, it will give you an idea of what is happening in the market. So on your left is the oscillators. That is, these are indicators that are classified as oscillators. That is, these are indicators that tells you either the market is overbought or the market is oversold or the market is neutral. Okay. Then to your right, these are moving average. So these are indicators that tells you whether the market is trending. Okay. So now, if I scroll down all the way, you will see how this decision is being made. If you look at here on this right hand side where you have moving averages, you can see that we have all the way from 200 moving average 200. We have exponential moving average 200. We have simple moving average 200. We have exponential moving average 100. We have simple moving average 100. We have exponential 50, simple 50. Now, this arrangement that you are seeing here now, you can come to your chart. You can come to your chart and say, that thing that I'm seeing in trading view, I want to create it on my chart. So you come to your chart here and go to moving averages. So moving averages here. So first I come here and I say apply 200 exponential. I hope you guys are following me. Okay. Apply 200 exponential to this chart. I use white color for 200. Okay, I prefer using black for 200. Black for 200. So then apply still 200, but this time simple. Okay, apply. So I have 200 lines there. One is exponential, one is simple. Then I go to the next one, 100, 100. And then I say exponential. Okay, I change the color to white. And I say reduce the thickness, and then 100. And then I go again, I say on this time, 100 simple. Okay, then I do for 50. So 50, I change the color to blue. And then I reduce the thickness a little bit, and then 50. So this is 50 exponential, and then I also apply 50 simple. Okay, so I've done. I hope you guys are watching and following. Then now let's come back to trading view. So we have done this, we have done this, we've done this, and then we've done this. So the next is 30, 20, 10. So we do the same thing for 30, 20, and 10. So come back to our chart. We'll go moving average, 30, exponential, change the color to dark golden rod, and say apply. Go again, same 30s. Sorry, it's like the first one I made a mistake. It's like I use smooth instead of, let's take it back. 30 exponential. Apply. Okay. Let's say close. Then we'll go again. Moving average. 30 simple. Apply. And then we'll go to the next one. 20. Okay. Exponential. I change the color to navy blue. Navy blue. Okay. And then we'll say apply exponential. Apply simple. Okay. And then let's apply the next one, which is 10. We say apply exponential. Change the color to maroon. Exponential. And then apply simple. Okay. Now everything I've done now, you have the ability to do it by yourself, you know, on your chart. So now we have successfully created this thing that is showing you this result. This result that you are seeing here now, we have successfully created it on our chart. Okay. Then to your left, you want to choose any of all this. So I have all of this. I might not be able to put all this on my chart because the chart will be too clumsy, right? So you see that, okay, let's just take stochastic. We'll take stochastic 1433. So we'll just come here and take one oscillator, say oscillator. So you come under oscillator and select stochastic. Okay. So go stochastic oscillator. I will say 14, 3, 3. So we're using their setting. Okay. And then we'll say apply. So this is your stochastic. Let's pull it up a little bit. That's it. Perfect. So now we've created, with this, we have just created a trading system. Okay. We've created a trading system. And I also want to explain to you, this stochastic you are seeing, even the lines that you see in this stochastic, they are also moving averages. Okay. Those values that you see, this 1433, they are actually moving averages as well. Okay. But we can leave that for now. So now that we have created this, you cannot come look at your trading view. It's telling you for which currency is this, US dollar. So let's switch our charts to US dollar. US dollar, yeah, US dollar index, USD index right here. So this is exactly what we are saying. All right. Okay. I'm sure it's better. So this is exactly what we are looking at here on trading view. Okay, so on this trading view, look at what the moving average are saying. It's telling you that the market is buying, you know, that the buy is strong based on the daily chart. So let's change this to daily chart. This is H4, right? So let's change it to daily chart. So it's telling you that the buy is strong. Now, a strong buy means that you see all these moving averages. It means that all these moving averages that you are seeing. Okay, so let's look at it here. Let's start from here. exponential moving average 10 and simple moving average 10, the action is buy. 20 is buy. So all the moving averages are buying, even the 200. Even the 200 is telling you that the market is buying. So if all the moving averages are telling you that the market is buying, what does it mean? It means that the market, has actually broken above all the moving averages. Okay? It means that the market has broken up. So starting from the very first one, which is 10, the market has broken above 10, it has broken above 20, it has broken above 30, it has broken above 50. Typically, you want to actually take it when it breaks above 50. Aggressively, you may want to take it when it breaks above 20 or 10. Okay, that's being aggressive. But conservative people will want to take it when it breaks above 50 or when it breaks above 50 and pulls back to around 50. So look at it. For instance, here, the market breaks everything, even breaks 200 and then pulls back into the 200. When it pulls back into 200, at that point when the market goes back and touches 200, you draw a counter trend line. Now, when the market now breaks that counter trend line in the favor of sell, like in this case, then you start selling. And that's how this market came down with all this profit. Okay. Now, this is the second time the market is coming to this 200. So another possible thing that can happen is that this market will probably hit 200 and break 10 or 20, and then you have another sell continuation. Is it making sense to you guys? If you look at it like this, if you look at all these lines, it's so confusing, it's so scattered, right? It's not straightforward. It's not very clear. But you that drew all this line, you know what you are drawing. You understand why you drew the line. This market that bought like this now, the one reason why this market run like this, for those that are familiar with our classes, I will start by first of all putting a horizontal line here. And then I move the market to the first candle body. And then I come and put another horizontal line here. I move it to the next candle body after the first one, which is this one. And then I draw a line from this candle body to this candle body. Okay. And then I come to my stochastic. I draw a line from this one, this candle body here, the corresponding point on the stochastic, which is the low. Take the lowest point on this stochastic and take it to the lowest point on this stochastic here. So I draw it, say, from here or here. I draw it to this point. Now, can you see that the market created what we call a divergence? The market created a divergence. Okay, it's very obvious, right? The stochastic is telling us that the market has created a higher low. A low that is higher than the previous low is a higher low. But the chart itself, the currency, the candlestick, is telling us that the market has created a lower low. Capish? The market created a lower low on the chart, and then it created a higher low on stochastic. And I said, whenever you see this, I will take you quickly to baby pips. Okay, come to baby pips. Okay, let's just go baby pips home page. Search for divergence. Okay, divergence trading. So let's see. All right. So this is it. So look at what baby pips is telling you about divergence. Let me just 1 minute. Divergence. Okay, yeah. So these are the two types of divergence: regular divergence and eddy divergence. So let's see the demonstration. So this is the demonstration. So when the market makes a lower low, okay, and the indicator makes a higher low, you have what we call bullish divergence, right? And then when the market makes a higher high and the indicator makes a lower high, you have what we call a bearish divergence. And that's exactly what you just saw on this chart. Okay. So usually there are different ways you trade it. Some people will enter knowing fully well that this has created a higher low. Some people will enter it from this very point. Your buy will be here, right here at this bottom here. Okay. Why some people will say from the last high before this low, draw a trend line. A break of that trend line is your entry. While some conservative people will say, draw a horizontal line across the high, the last high. A break of this will be your entry. So I have three entries. Aggressive entry right at the point where you observe that the market has created a lower low and then a higher low on the indicator. This is your entry to buy. Okay. I mean, if you are a divergence trader, if your own knowledge of trading is divergence, trust me, you will take it from this very beginning. The same thing happened here. Look at this point. Look at this point here. This is a lower low, and this is a higher low. Look at it. This buy that you see this market run from year to year, just in case you don't know, from year to year, that is a whooping 213 pips. 213 pips in 18 days. Now, if you take the pip size of USD and use to multiply this value, you see that is a lot of money. Okay, so this moves. Yeah. So some people, the only thing they trade in this market is divergence. They just make up their mind they will not trade anything except they see divergence. Okay, so if I want to trade this, my best entry for this divergence would be right here, the close of this bearish candle. This will be my entry. I enter here, stop loss below this low, the market will run in your favor. So when you are trading divergence, your stop loss is usually very small. I'm risking 49 pips and the market has already done 324 pips. So who can tell me the ratio of the risk to the reward? Risk to reward, 50 pips to 300 and, okay, so let's just say 50 pips to 300 pips. Okay, that's 1 to 6, right? 1 to 6. That's the kind of trade, that's the kind of entry you want to get. If you feel that all this mathematics, all this calculation we are doing to trade is too much, you can make up your mind and say you want to trade only divergence. But I will tell you, if you are going to trade divergence, the divergence that forms on the lower time frame, they are not as effective as the ones that form on the higher time frame. So if you want to trade divergence, I will advise that you do that on the daily time frame. Daily time frame. Okay? Anything other than daily time frame, you need to think twice. Because it's possible on the bigger time frame, like for instance, this market that is diverging now, on a smaller time frame, maybe H4 or this, it would have created, some divergence situation, that did not hold. But because you are not looking at the daily time frame, you enter the trade and then you have you get kicked out of the trade because a bigger time frame is still pushing the market to a particular direction. So that's why you want to look at all the time frames, together at the same time. You want to see what all the time frames are doing at the same time. Now look at this same divergence on the 4 hour. Okay. Even though we have the big divergence that is coming from here, you can see that between year and year, the market also diverges. So you see from year to year, why it's a higher low, and then from year to year, it's a lower low. And that also makes this market to run, the way it ran. You see, divergence is the only way you can enter the market from the beginning as far as this forex market is concerned. If you want to take the trade and you want to take it from the beginning, which is the desire of every forex trader, you have to use the option of divergence trading. But it also comes with its own risk, because a lot of time there are a lot of fakers that when you try to, maybe at the point where you buy, the market has not fully diverged and you have already taken the trade. The market will go as if it wants to go in your favor, and next thing you know, boom, the market comes down and take you out of the trade. So, I mean, these are risks, that are inherent, in trading. So it's key that you understand this phenomenon. All right, so let's go back to what I was trying to explain. So basically, if you come to your trading view, go back to our trading view. If these guys are saying that the market is a buy, and these guys are saying that the market is a sell, this is where we need this summary. Okay, so a combination of the actions of the oscillators and the action of the moving average give us the overall bias of that pair. So even though the moving average is saying that the market is a strong buy, because oscillator says the market is selling. Remember, it's not just one oscillator we are using. We are using several oscillators. And if you look at all the oscillators, look at their action. This one is neutral, neutral, sell, neutral, buy, sell, neutral, 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 sell, neutral. So based on this action, this is the result. Okay, a sell. And that automatically put this market in a buy overall decision. Overall decision for US dollar is a buy. Now, if the overall decision for US dollar is a buy, tell me what will happen to GBP USD? What will happen to USD CHF? What will happen to AUD USD, NZD USD? Now, that the US dollar is buying, and you may think that, okay, it's going to pull down the NZD USD or the GBP USD, you also now need to consider what the GBP is doing. So if this is US dollar, this is the overall action of the US dollar, is a buy, then let's switch to another currency. Okay, so let's switch to GBP. GBP. Let me see if I can pull it from here. Okay. So let's switch to GBP. Let's check maybe USD, USD. Let me see, switch us. Okay, let me just go back to the main page and pick it. So just go back to one more step. Oh, sorry. Okay, let's go back here. So you come here and pick GBP. Here's GBP. Okay, so this is GBP. So we'll pick GBP, and then we'll go also technical, and let's see what's the overall decision. Boom. So GBP decision says GBP is a sell. Can you see that? All the moving average are saying that GBP is selling. The oscillators are neutral, and then it said the overall decision is that GBP is a sell. So when you say GBP is a sell, that means GBP is weak, right? So if GBP is weak, then the US dollar will be able to pull the GBP. So for the currency pair GBP USD, because USD is a buy, that buy means that USD is strong. And GBP is a sell, meaning that GBP is weak. Then GBP USD overall will be a sell. So let's go to GBP USD and see let's see what we're going to get. So let's duplicate this and then let's take major pair. So GBP USD. So let's see GBP USD. So GBP USD technical. So this is the summary. So the summary of GBP USD say if USD is neutral. Moving average are saying that it's a strong sell. Okay, it's a sell. These guys are saying that it's a neutral, and then overall it's neutral. So it's in between sell and buy. So practically no decision. But then if you come to looking at these two individually, okay, you will say that GBP USD is going to sell. So, and if you go to GBP USD, we'll come here and then let's change this chart to GBP USD. Okay. So look at GBP USD. GBP USD is actually below the 200 moving average. And you know what the 200 moving average does? It splits the market into a buy and a sell zone. Okay? Is that clear to all of us? The moving average 200 splits the market into a sell and a buy zone. Everything above the 200 moving average means that the market is a buy. Tells you the market is buying. You can see how well, look at this one. After the market breaks above the 200, the market just came here and kissed the 200. And look at what happened. It ran up. And then now the market has come down. It has broken below the 200. In fact, at this point, it has tested this 200, which is what is resulting to this sell. So because this market is below the 200, the most favored trade is a sell. The most favored trade for GBP USD is a sell. So all you need is to look for a candlestick pattern, that favors that sell. You look for a candlestick pattern. So as soon as you get a candlestick pattern that favors this sell, trust me, this market is going to run down. But as we speak, if I want to sell GBP USD, I will sell it right now. Based on this 4-hour chart, I will sell GBP USD right now. Now this is the right time to actually sell. Okay? Is it clear?
Yes, it is.
Okay, so basically that's how you use these tools. These are generic tools. And then I showed you the market make, right? That shows us the market snapshot. Let's just refresh it and see. So this gives you an overview. And like I told you that this thing works, right? I've used it and I'm still using it. It works. This is a replica of what I just showed to you now, okay, on TradingView. So this does, exactly the same thing. Okay, can you guys see my screen now? The network actually fluctuated.
Yes, I can.
Okay, so as I was saying that this currency meter that you see from Baby Pips, it replicates what I just showed you on this trading view. Okay, so it just a faithful replica of what you have here. But this one, it gives you, like a way to quickly make a decision. Now, Joshua, I saw you were asking the other day if it changes, right? Yes, it does
Yeah.
change. It does change because if you look at my setting, under my setting, you can see there's an option here that say read time, okay, and then there's a time frame. So you can actually change this time frame to any time frame of your choice, and then you can change this read time to say, I want to know what the market is going to do after the close of the last candle. So if you are dealing with the close of the last candle, this is the result. But I prefer to use the one that is real time, okay, that fluctuates. Okay, it tells me, okay, the market has changed. So right now, this thing is telling me that USD is not strong, it's weak. Okay, but Euro, JPY, and GBP, they are strong. So now in this case, because of because of you know, because of the what you want to do, you can use this to determine which currency is strong and which currency is weak. Because the truth is that in trading, you try to pair a strong and a weak currency.
Yeah, I don't know.
Okay, you try to pair a strong and a weak currency. Now, in pairing a strong and a weak currency, this is one way that you can look at it. Another way you can look at it is through the news. Okay, maybe if you have Bloomberg, for instance, that is telling you what is happening in various market economies, you'll be able to know that okay, between US dollar and Nigerian naira, you'll be able to tell the relationship, and you'll be able to tell, okay, that USD is strong against the Nigerian naira or USD is weak against the Nigerian naira. You'll be able to tell. Sorry, can you hear me now?
Yes, I can, Patrick.
So if I tell you that Nigeria frustrate people, okay, as a country, they really frustrate people. In my house, I have MTN 5G that I'm paying for. Now I went to buy TZT. In fact, I even paid for 6 months. All this network put together, still I cannot get a stable internet. It's crazy.
It's terrible. It's ridiculous.
Really, really ridiculous. And this is not cheap. I paid
I
so much,
know.
to make sure that hey, I'm able to get something that is good, but still, it's not making sense.
It's very frustrating. Just horrible.
It's well.
It is well. That's all we can say.
Okay, so as I was saying, so you can use this to make a basic decision of, whether the market is going to buy or sell based on strong versus weak currency. Okay, but like I said on the chart, you have done this, right? So me, what I've done is that I have a template. Okay, let me just share my template with you. And this template is what I usually, use for my trading. And it tends to reduce, my analysis time. A lot of people, a lot of people will say, oh, this thing is complicated, it's cumbersome. No, Okay. Now, I'll just explain this template to you, and it's pretty simple to understand. So you see this black line under is more like, okay, let me take it. Let me put it to 1 hour because this template is for 1 hour. Okay. So I have for 1 hour, I have for 4 hour, I have for different time frame. Okay. So now, if you look at this template on the main screen, I have a set of indicators. Okay. On the bottom window, I also have a set of indicators, right? Now they are all working together in the sense that, remember, indicators will only help you to know, they just give you like an insight to what the market is doing. So they don't make the final decision for you. You will still make the final decision by yourself, but it's good, to have them. So let me throw that stochastic here now that I brought this one out. So let me just drop that stochastic that I use just now. I can add it to this template and say, okay, look, let's see Friday. Okay. So now with this stochastic that I've added, it helped me to see when the market is oversold and when the market is overbought. When the market is below this 20, the market is oversold. And when the market is above this 80, the market is overbought. Now, even though you see that this market is doing as if it's buying, the stochastic is telling you that the market is coming from overbought condition. And it has not go below the oversold that you say, okay, the market has finished selling. No, because it's coming from overbought, meaning the market is selling. For this sell to end, this market must gravitate into the oversold region. You see that? This region must gravitate into the oversold region. So here on the main screen, all these lines that you see, they are moving average, right? The only thing is the moving average is that it's a paid indicator. It's not a free indicator. I bought it. Okay. Is that, let me just open it for you so that you see. So this indicator, you see, this is true TL moving average. So this is one indicator that gives you a moving average with a time frame. You see, this is 4 hour. The chart I'm looking at is 1 hour, but I'm dropping a 4 hour, moving average on the 1 hour chart. So, like I've told you before, I say whenever your moving averages are lined up, and what do I mean by lined up? When your moving averages are parallel to each other, it means the market is trending. And remember, you were told that this market trend 30 times, 30% rather. The market trend 30% of the time, and what? And ranges 70% of the time. So you can see the time that the market trend is very, very small compared to the time that it ranges. So I want to identify that trend. Where is that trend? When these lines are parallel to each other. And now the two key lines for me are these two black lines, this black line and this black line. So when these two black lines are parallel to each other, even though this market came and break below this first black line, in as much as this black line has not crossed this black line, the market is still trending. The market will only stop to trend when this black line now crosses below this black line. So when the thick black line is below, the market is trending up. When the thick black line is above, the market is trending down. Okay, so you need to set a condition like this. When you set a condition like this using your indicators, then you can now start making your trading decision very fast. Most time you see me, I come and say trading entry for so. I don't take too much time to do the analysis. Remember, I have a very busy schedule at work. And as busy as I am, imagine that I'm busy. In fact, let me just show you a sample. This is my office WhatsApp community. This is my office WhatsApp community. So you understand how busy I am. And for the service that I'm leading is a big service. Okay. So it requires a lot of so this is my office WhatsApp community. Now I have more than inside this community, I have more than 30 something groups. Okay. You see all these groups now. You see most of these groups, I'm in all these groups, and I read everything on this group on a daily basis, every day. Okay. These are groups, okay, that we manage. There are a lot. Okay. Now, if I can be doing this and I'm still able to come to open the chart and look for a trade, and I take a trade and I make money, then anybody should be able to do it. Trust me, anybody should be able to do it. If there's no magic, there's no magic in it. Do you understand? It's just that sometimes people, you know, it's either you are feeling that the knowledge that you have is not enough to trade the market, and as such, you are scared of the market. You don't need to be scared of the market. Like I said, see, if you know you are scared of losing money, don't even come to the forex market to start with. If you are scared that you will trade and you will lose, then then you shouldn't be trading. But if you know that there's a chance that you may lose, but even if you lose, you can correct your loss. Then you can come and start talking about trading. But if you are the type that knows that when you lose a dime, it will affect you, then you shouldn't be trading at all. Okay? And one way that will help you to be able to trade is when you are able to come up with a system of your own. Example is exactly what I just showed you now with the moving averages. Okay? Once you come up with a system of your own like that, like this system you see, I built this system for a long, I can tell you I built this system for more than 2 or 3 years. Why? Because from when I start building this system, I start fine-tuning it, fine-tuning it, fine-tuning it, fine-tuning until I get to this level where it is now. Okay. So if you look at the bottom, this is an indicator that is called solar wind joy. So when it's buying, it flips up. When it's selling, it flips down. Now, sometimes even this indicator do repent. Okay, so don't think that, oh, it's so effective and that, oh, it just flipped down. Yeah, no. Sometimes before it flips down, the market has gone far, and that will force it to flip down, and then it possibly will repent like maybe 2 or 3 candles backward. Okay, but then it's still okay. Even though it repents, it's still okay. It gives you an idea. Like from when the market flips down, you can now start looking for only sell opportunities. And when the market flips up, you start looking for only buy opportunities. Okay? In that way, so now I'm going to marry what the moving average is telling me and what this oscillator is telling me, and that will form the basis of my decision to take the trade or to open a trade. So I have to put all this consideration together. But yeah, the moving average does the whole of the magic. Because once the moving average is lined up, take for instance, let's see something like S&P. Okay, so let's see US 500. So US 500, this is the popular S&P that you know. So if you look at this S&P, for instance, now you see that the market is buying, right? This buy has been a long buy. If you flip this chart to 4 hour, you'll be able to see how well this market has been buying. Can you see? So every time the market pulls back, is an opportunity to continue. Pulls back, continue. Pulls back, continue. Your own is just to wait for pullback and continuation, because in this case, the market has already lined up telling you that the market is buying. Imagine from when the market all line up parallel somewhere here, okay, where you see that all the moving average are now parallel to each other from this black all the way to the top. You see that they are all parallel. From this point, you start looking for pull back, continuation, pull back, continuation. You can even see divergence, that favors. So you're just looking for things that favor this direction. Now, this could be the only trade you will take for even a complete period of 1 year. It doesn't matter. It's okay. If you are trading only this guy for like a period of 1 year, it's a lot of money. Now, if you flip it to daily chart, you see how well. Now, so look at this daily chart. Let me apply the daily. This is 1 hour. So let me apply the daily. If I apply the daily, this is how it looks like. This is how it looks like. Okay. Let me put the one without all this stuff. Okay. So look at it. This is how it looks like. So you see from the daily, you can see how well this market has been buying. So look at these two black lines. These two black lines, the thick one and the one that's not very thick. You can see that this line, both of them have been parallel for a long time. Can you see, even though when this market came and break into these two black line, it didn't shake the line. It didn't make the line to cross each other. No. For the fact that these two lines have not crossed each other, this market will continue to buy until such a time that these two lines will change direction. When they change direction, then S&P is not going to sell. You might have, short-term sell in between. Like for instance, this is a short-term sell. These are short-term sells. This is a short-term sell, short-term sell, and then continue. After the short-term sell, the market continue. So in this case, I thought the market is going to sell there, so I put a sell. Okay, but it hasn't sold. It hasn't sold. And if the market sell from here and comes down, even if it comes down all the way to these two lines, I like it to even come down to these two lines. When the market pulls back very well, it gives you an opportunity to enter at a point where your stop loss will be very small. Okay, and that's what we want to achieve. So when the market pulls back that way, you look for the continuation and then you take the trade. Okay, once you keep doing that, you can do that for as many currency pair as possible. It doesn't matter. Okay, it's your choice. Look at the overall picture of AUD USD. How the market has come to these two lines. Look at the first time it came back to these two lines and then it sold. It came back here, it sold, and now it has come back here again. So all I need to do is to draw. So let me push it out a little bit so that you can see the candle very well. All I need to do is to draw a line between here and here, and then the market breaks this line, okay? And then the market is selling. This is a massive sell for AUD USD. You can see how obvious it is. Okay. Now, even though this market has started the sell, can you see that this thing has not flipped down? Because sometimes if you say you want to wait until this thing flip down, you may not be able to enter the trade. So that's why you still need to apply your price action. The price action is that I want this market to come all the way to this black, in between these two black lines, and then let the market close below the bullish candle that leads to that line. If the market does that, I have a sell opportunity in my hand. Yeah, this market has come here and then it has broken below this bullish candle, that came to the region. I say I have a sell. So there are so many ways you can take the trade, so many ways. Okay. So the knowledge you have is a universal knowledge. It's a versatile knowledge. You can apply it in different ways. But then, like I said, if you feel that all the knowledge are too clumsy, you can stick to one. you can say, okay, because of the nature of this knowledge, I want to stay with, one option. And I say, okay, maybe that one option is divergence. You want to stick to only divergence. It's possible. You can trade only divergence. You want to stick to, you want to stick to when the entire moving average is lined up and then the market pulls back. You want to stick to the fact that the market comes back to the 200 moving average. You want to stick to the fact that the market comes back to the 50 moving average. It's all up to you. Anyone you want. Anyone you want to use, it works. Anyone you are using, it will work. Okay. And then also try to take advantage of the daily time frame. A lot, a lot happens on the daily time frame. Okay. A lot happens on the daily time frame. The daily time frame is one of the most accurate time frame to make your entry trading decision. The daily time frame. Okay. But people feel that, oh, it's too big, it takes too much time. You just look at the market once in a day. Trust me, it's better, than out of uncertainty, you go to 30 minutes, you enter a trade, the next moment you're out of the trade, the next thing the market has dribbled you. The news most time is not very visible on the daily time frame. Most time the news is not very visible on the daily time frame, but it's visible on the smaller time frame. Okay? It's very visible on the smaller time frame. So you will see the effect more on the smaller time frame than the daily time frame. 1 minute. Somebody's trying to call me. All right. So this explanation that I'm trying to explain to you of my trading system, is it clear? Is this something you think you can do? For me, I developed this by myself, and I use. If you look at my system for this daily, I use. Let me see what I use here. I use 60. Okay, I use 60 and I use smoothed. Okay, so this is weekly 60 smoothed. This is this is uh this is daily. This is daily smoothed. Okay, and then this is 4 hours smoothed. So now what I'm trying to do is I'm trying to see the relationship between the smaller time frame and the big time frame. So in this chart, on this chart, you will see that the market will first of all break the 4 hour and then gravitate to the daily and then goes to the weekly. That's exactly what the market is doing. This is for my daily time frame. If you go to my 4 hour time frame, you will see 1 hour, you will see 4 hour, you will see daily. If you go to my 1 hour, you will see 30 minutes, you will see 1 hour, you see 4 hour, you see daily. Okay, so I mean it's just a way to see, how the market is responding. And remember, I think I've mentioned it before that you see this candlestick, this is your candlestick that you call candlestick. You see this candlestick is actually moving average one. And I will prove it to you that what you are seeing is moving average one. This thing you are seeing is moving average one. You can come to properties, and then come to colors, and then see your chart, right? This is your line chart. If I put a color on this line chart, say white, and I say okay. If I come here and select line chart, this is my line chart. I want you to look at this, my line chart, and then I want to apply moving average one. Moving average one. Okay. So let's apply moving average 1 to this. You see, as you can see, your moving average 1 is your line chart. So if I remove this line chart now, this line chart, if I come here and I say remove the line chart, this our line chart that is showing now, is it white? Remove this white. Can you see the moving average? This is your moving average 1. Is it not the same thing with your line chart? It's exactly the same thing with your line chart. So the candlestick, and this is your candlestick, right? So if I put the candlestick now, this candlestick, if I apply color to the line chart, say white, okay. If I switch it to line, look at it. See, it tallies with the moving average. Look at the moving average 1. Look at it. See that? Line chart. See, it's exactly the same thing. So now, because of this, I came to the conclusion that since moving average 1 is the same thing as a candle, okay, I now came to the conclusion that, okay, so if of course, for me to be able to apply other moving average to my chart, I need to be careful of the selection of the number. So I try to, use between 10 and 60, because the value, that value 10, a value 60, it tells, if you say, if you are on a if you are on a if you are on a 1 hour chart, it tells you moving average 50, for instance. It tells you your lagging, that's your period. The lagging period that you are looking is 50 candles, okay, behind, to make your analysis decision. 50 candles behind. So if you are using a 4 hour and you're applying 50, it's still the same 50 candles behind, but the candlestick in 4 hour, they have a higher weight than the candlestick in 1 hour. So you need 4 hours, you need 4 candles from 1 hour to make up one candle from 4 hour. Okay. So that to a large extent affects, how the market, behave, or how the market respond. But knowing that this is moving average 1 is a whole lot of exposure. Okay. It's a whole lot of secret reveal. So it makes it easy for me to appreciate what the market is doing. And that's why I can develop, my trade. So those moving average that I put that as a 4 hour, so let me say you have moving average that is 4 hour, moving average that is 1 hour, 1 hour that is 2 hours, 5 hours, one day. And then all these moving average are going in the same direction. It tells you that's the direction that the market is going. It just summarizes everything for you. It tells you the market is moving in that direction. Okay. But, okay. Sorry. Can you guys hear me? Just want to be sure.
Yes, I can hear you from the side.
Okay. All right. Okay, so every one of you can develop, something like this, and you'll be able to appreciate, the market better. And as you are doing it, I mean, like I said, try it. Go to what's it called? Go to demo. Try it. Okay. When you try it and it's working for you for demo, it's easy for you to come to the real life market and do it. And don't be scared. Like I said, if you know you are scared, don't bother because you don't want to have BP. But once you know what you are doing and you are able to manage that your risk appetite, you will not really be bothered. Sometimes I put a trade, I walk out of the trade, I don't care. Like I think, okay. Sometimes you put a trade and then the market uh goes against your analysis and then you are in loss. Now, but you need to look at that loss if it's way beyond what you can take. And if you know that if that loss continue, you cannot hold it, then the best thing is for you to close your trade. You close your trade and you cut your losses. And then you are able to look at the market another time and then you take a trade. So it's very key for you to do that so that you don't lose more than you can take. You don't lose more than your system, can accommodate. And that, so that it don't gives you even more problem. Okay, so it's very important that you do that. Okay. So
I have a
like,
question.
okay, go ahead.
Yeah, is there a reason why take profits? I don't know. I had a situation really 2 days back. I put my take profit. The market went in my favor, so I decided to. The market fluctuates. It goes up and it comes down, as in it kind of keeps moving. Back
Yeah.
and forth. So it went in my favor. So I put a take profit. It hit my take profit and continued, and it didn't take me out of the market. Is there a reason for that?
It hits your take profit and it didn't fail.
Yeah, well, it didn't take me out of the market. It just kept going. So I noticed it quickly, and I had to manually exit.
Mm.
Has it happened to you before?
So what currency pair were you trading?
GPB USD.
GBP USD. GBP USD spread is not so much now. Because sometimes if you are trading a currency with widespread, right? Now,
Okay.
there are two components of the spread, the bid and the ask. Okay.
Yeah.
So now, if you are looking at your chart and if you let me use something like I think will give us widespread. This can give us widespread. Let's see. Let's use try. USD. There's something like this one will give you a widespread. Okay. So, all right. So if you look at this end, you're seeing two figures, right? One up, one
Yeah.
down. Okay. Let me zoom it out and see. Okay, beautiful. Yeah, are you seeing two figures there? See one figure here and
Mm-hmm.
then another one here. Okay. So most times, what happens is that the market will come to your take profit or your stop loss, and then maybe it's this one, you see this upper one that has reached your take profit, and this one has not reached your take profit. Okay. It will not feel it will not trigger. Okay. But you that is looking at it, You are saying that, oh, it has reached my take profit. And why your own is, why am I kind of surprised your own is GBP USD. GBP USD does not have wide spread. Okay. The spread of GBP USD is small. So usually 2 pips, 3 pips, don't even get to 3 pips most time. Okay, for GBP USD. So I'm surprised why your own is not filling.
I was on a 15 minutes time frame. So
Okay. So
yeah,
that
I was
that
on a 15 minutes time frame. Just a
that
quick one because I was at work. I just wanted to just do a quick one and
yeah.
get out while I was
Now
doing other things.
look at this spread now. Look at this bid and ask relationship now. I want you to see it on a 15 minutes time frame. Can you see that? Can you see that? So this, if this is your chart, and then the market is here, and then you say, Mark, this has entered, you say, oh, it has reached your take profit. But see, this one has not gotten there. Okay, the bid has reached, but the ask has not reached, so it will not fill. This is the
Okay.
disadvantage of trading, with small time frame. But look at this same bid and ask now. If you switch this chart to daily, you see it's not even visible. You see how small it is. See it on five
Okay.
minutes. See how wide it is on 5 minutes. 15 minutes. See how wide it is. So I'm sure this is what happened to that your trade. And also take note, immediately the market, passes the what do you call it? The market passes the active zone, okay? Your spread will automatically increase for all the currency pairs. That is, if you look at the UK time, if you look at UK time from 5 p.m. UK time, the spread of all your currency pairs will automatically increase because you have left the active period of the market. Remember, UK market alone controls 70% of all the transactions that happen in the forex market.
Okay.
So I'm sure that's what happens to your trade. Why you are not
And
able to.
one other thing again, I noticed that when the market is going against you, it's I don't know, it increases faster than when it's in your favor. Even
Yes,
the action,
that's
the movement
correct.
of the market, yeah, the movement of the market, it's when it's in your direction, it's climbing. You see it climbing, but the actual reflection on what you're getting is not as fast as when you're losing at the same speed.
Yeah, correct. Now the reason why it's like that is also because of the spread. Okay. You remember
Okay.
when you enter the trade, you are going to see a negative value first, right?
Yeah.
That negative value is what the broker is charging you to take the trade. Now,
Okay.
that negative value, yes, that's the cost that you are paying for using the platform to trade, right? And that negative
Okay.
value is adding to your trading if your trade is not positive, if your trade is negative. So it tends to increase your negative as the market is moving against you. Okay. So
Okay.
now what you need to do is to struggle to make sure that you make more than that value that the broker is collecting from you.
Okay. That makes sense now. Because at some point I was almost getting worried that is it that the broker, they're manipulating the market?
Yeah, of course, some of the broker they do manipulate the market, but trust me, it's not that bad. Once you know what you are doing, the broker cannot manipulate your trade because the broker will not want to risk their own hard-earned money because of only one trader. Remember, you are not the only person trading in their platform. There are plenty people trading in their
Yeah, that's
platform.
true.
Eh,
Yeah.
So, in an attempt to try to manipulate the market against you, the broker may lose more. Okay, if you are the broker's target, then the broker will be risking more because there are other people that are trading using their platform. So those manipulation stuff, to some extent, they don't bother me. They don't bother me. And when I started, I did mention that GBP USD in Nigeria is GBP USD everywhere in the world. So if it's being manipulated, you will see it. The only time I know that you will say, okay, maybe the broker is manipulating is when the broker, you know, kind of make the market to draw a very long wick as against what other brokers are doing. So maybe the low in GBP USD, remember, sometimes the broker cannot manipulate the body of the candle. The only manipulation they can do is on the wick. Okay. So if you look at this line chart that you are looking at now, this line chart is actually the body of the candle. This line chart that you are seeing now, it's actually the body. You see all these sharp points that you are seeing, they are close and open of the candle. Okay, because this is a line chart. You see all this edge there. But now these are not the wick. If I apply the candle, can you see the wick? Look at where the wick is here. Look at
Yeah.
where the body is. Can you see it? This is the body. The broker cannot manipulate this one, but the broker can manipulate this one. This wick now that is here, this wick now that is here, in some brokers, this wick is possibly somewhere here. In some broker, it is here. In some broker, it is here. Do you understand? So this is where the broker can
Yeah.
do manipulation. Now, what the overall effect of this manipulation is that if you are doing your support and resistance, and you are saying that, oh, it is the weak that is the support and it's the weak that is the resistance, then your analysis will be wrong because you are analyzing with the broker's manipulated weak value. The broker is not going to affect the candle body because remember, the candle body is the actual trading volume. See, when I put the mass here, I want you to look at this, look at this, look at this, look at my mass. Time, open price, high, low, close price, and volume. You see this volume? They cannot manipulate. This is the actual trading volume that happened in that candle. So when I put my mouse, on this candlestick, you will see these values here, they will populate. So let's see, for instance, so let's see any candle, just put it on any candle here, any candle. So let's say this candle. Now look at this candle. See the volume. If you look to the down, look at this area of the screen. Okay, look at this area. Now when I put this candle, when I put my mouse, you see the volume is 292 for this candle. Look at the value V. V is 292. That 292 cannot be manipulated. That's the actual volume of transaction that happened in this candle. But you see the wick can be manipulated. The wick can be changed by the broker. The wick can be affected by the broker.
Okay.
The position of this wick can be affected. Maybe you actually analyze that this market is going to sell, and maybe you sell, and for some reason, you put your stop loss above this wick. And then the broker came with this long wick and take you out of the trade. And then eventually the market still sell. Okay. If you remove the wick from these candles, if you come here and take off the wick, none. And this is the reality of the candlestick. So when we say the resistance, see, this is the actual resistance here. This is the actual resistance that is bringing this market down. This is the actual support that causes this market to rise. You understand? But if you put the week, you see that week is going to tell you something completely different. Okay? So the week is telling you that this is the support, this is the resistance, which in reality is not very correct.
Okay.
Okay.
Okay. It makes sense.
Does this mean that interpretation of that week, somebody will look at it as a strong rejection?
Yes.
Does it mean that that's a wrong interpretation?
No, it's not a wrong interpretation. So if the week, like for instance, this long week now, the interpretation means that the market, this area of the market, okay, there are more sellers than buyers. That's the interpretation. And that's why the market came all the way to this up and then it came back down. But I'm telling you that this one that you are looking at now, this is FSTM. Go and look at another broker. It may not be like this. This week may not be this long. But if FSTM is telling you that this week is this long, and then you are interpreting it that, oh, this is a strong rejection, and another broker is telling you that this week is not this long, you can see that your analysis is going to be faulty.
I use the body to do my analysis anyway. Because it's constantly moving back and forth. So it's in a way it stops and it changes. So it's more like volume movement or price action. How it's going and opening on the next one.
Yeah, you are correct. You are correct. So if you look at the body, you will see. Okay. If you look at the body, you will see the you know the effect. You see the actual effect of what is happening in the market. But if you look at the week, even though the week is good, it tells you, it gives you, most especially when you use it to indicate rejection, when you use it to indicate a particular candlestick pattern or type, that's something that will help you to make a decision whether the candle you are seeing is a decision candle or indecision candlestick, right? And also if that decision is coming from a potential support or resistance zone. Now all this will help your analysis, right? But then, like I said, for various brokers, these things are not 100% the same. Let me just see. Let me just open a different broker and see if we can spot a difference. So this is AUDNZD.
Incoming mail.
So this is derivative. So this derivative, now let's see. Here's our AUDNZD. AUDNZD. I come to this, and then you switch this to 15 minutes, and then you zoom it out. So, okay, so you see this one now. This is deriv, okay? AUDNZD. So this AUDNZD now, and this AUDNZD, from FSTM. So let's come here. Say this is the price point for this week. On this one is 1.10765. Okay, so you come to the one of FSTM, and let's go to the price point for that week. So usually they should be very close, 1.0746. Okay. Let me okay, just misbehaving here. Okay, so all right. So if you look at this is what I'm trying to compare. So 1.10765. Let's move it. Yeah, I want to see if I can get it 100%. 1.0764. Okay, so that's the best we can get. So here is 1.0744. So now let's come to this is not open. Okay, so let's see. AUDNZD. Let's see. So this is AUDNZD 15 minutes. So let's see this one now. This is AUDNZD 15. Okay, so now I want you to look at this chart now. Mm. Look at this chart. Can you all see my screen?
Yes.
Okay, I want you to look at this chart. This is AUDNZD 15 minutes. Look at it. Look at it very well. Okay. This is from FXTM. Then this is AUDNZD 15 minutes. Same 15 minutes. This is from Deriv. I want you to look at this place. Look at this place here. Can you see the end of the chart? Where the chart is currently, I want you to look at it very well. Look at the one of Deriv, and then look at the one of FSTM. Are they the same thing? Can you see what I'm showing you? See FSTM. See the wicks on the FSTM. See this first candle.
Where is the other one? This is just one.
Oh, we can see.
See the other one. See the other one. This is Deriv. Look at it. Can you see that all those plenty
Yeah.
wicks you are seeing here on this FSTM now, they are not showing here on the reef. Look at it. It's the same chart. Look at see the wick. This one from the up is the same thing as this one from the
Oh,
up here.
yeah.
Okay. And then to this look at the behavior here. Can see that
It's
on
shorter.
totally different, right? And then on the reef, look at it, is totally different. So I'm telling you that if you are doing analysis like this, your analysis could be wrong because of what you are seeing. You can do a wrong analysis and you will be thinking that you are right.
Okay.
I don't know if you guys are getting me.
So how do you avoid these traps? How do you,
To
yeah, I get
avoid
you.
trap is
How do we
body.
avoid it?
To avoid this trap is to rely on the body, rely on the candle body. Instead of the wick. I mean, if I go like now, okay, this is okay, let's see this one has come up. Let's see, is me apply it. So AUD NZD, this AUD NZD, FTMO. So let's see. So let's go 15 minutes. 15 minutes. So let's allow it to do it. Boom, 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 boom. So allow it to do.
I have an observation. I don't know if anybody has observed it or if it's valid.
FTMO has even opened. You see,
Okay.
FTMO has opened. Now you can see, you see the way it fell down all the way. If you see FTMO chart, look at FTMO chart and the reef chart. Can you see that they are the same? Look at where the reef close. You see this FTMO. Oh, this is okay now. Even the derivative has opened too. You can see. Okay, it's 10 o'clock. Yeah, the market has opened. So you see. Now let's see FSTM. FSTM has not opened. So by the time FSTM will open, it's going to do a big push down. Okay. See that?
Yeah, that's what I noticed. I noticed between 6 and let's say about 8 in the morning, all this sort of massive push, on a 15 minutes, that's when it happens. Then as it goes towards the day, you start seeing them fighting each other back and forth, the high volatility. Yeah, I don't know if anybody have observed it, because that's my observation for a while. And I've noticed that between 6 in the morning and about 8, about that,
Mm-hmm.
all those long movements, you notice them about that time. So if you're going if you're taking a trade and those periods, you have chances of having a very protracted or continuous direction.
Okay. Just 1 minute till I'm coming, trying to light up this thing.
So sometimes I look at the trade, I put my cursor on those long bits, and I look at the time those activities happen. It's between 6 in the morning and
Okay. That's a good observation.
8 in a week.
Six, seven, six.
With respect to GPBUSD, sorry, let me be specific.
Just give me like 2 minutes, I'm coming. Okay, sorry, I'm back. All right, Joshua, you were saying something. You said what?
With respect to GBP USD, most of those long candle movement on a 15 minutes chart happens between 6 in the morning and 8,
Okay.
at least 3 times a week. From what I've observed, I don't know if my observation is right.
Well, I mean,
Could it be
if
because
you
after
take
a
your,
while, you have to,
no, if you take your time, if you take your time to observe the chart, yes, you 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 you'll be able to tell, what the market is doing over time. And that's one of the that's meant to be one of the future of a trader, right? Anybody that is trading the forex market should be able to look at the chart. Now, there's something I want to show to you guys. I've shown you before, but I don't know how many of us actually caught it. So I did. Let me see if I can pull out that presentation quickly. Uh, MTI trading, yeah. So let me use this one as an example. All right. Mhm. So let me know if you can see my screen very well. So if you look at this presentation, this is something we've run through before. So if the market is trending down, the market is creating lower lows, lower lows, lower lows, lower lows, lower lows, right? And if it's trending up, it's going to be creating higher highs, higher highs. Okay. Now, if you look at this, every of those high the market creates, when the market creates a lower low, it goes and creates a lower high. Every of those lower high the market creates, they become past resistances. And now these past resistances, I don't want you to see it as the wick. I want you to see it as the body. You understand? I want you to see the past resistances as the body of the candle. Okay, I'm going to come back to it shortly. So now when the market wants to change direction, what the market will do is the market will break the trend line, come and take out, look at this resistance now. It will take out this resistance and then it will pull back. It will go and take out this resistance and then it will pull back again. It will go and take out and then it will pull back. This is how the market gravitates to any of the direction is going when the market is trending. Okay. So when it does that, just the same thing for sell, all the past support become key support level. And then when it wants to take it out, it breaks the trend and then take out the support and then pulls back. Now at that point, the market is now bearish. Now, come to our chart. Come to our chart here. Okay. So if you look at this chart, for instance, this GBP USD that you are looking at now, look at GBP USD. The market, if we say the market is buying, we say the market is buying, then we first of all come to where was the lowest point the market got to before it started buying. It's here. Okay. Where was the last high before this low? Is what? Is here. So when the market break this place, the market pulls back and then continues. The market goes and break the next one. Look at the next one here. Break it, pulls back, and then continues. Now it has not reached, the market has not reached this one. It has not reached here. It has not reached here. This is the next two levels. Okay. So what the market is doing right now is that the market is pulling back. So in the big view, yes, the market is pulling back, and this pullback will most likely continue until I think it's meant to hit this place very well, most likely. It's either hits this place or it comes and hits this place, and then it goes rally and try to, come to take out this place. Okay, so that's the view. But you see, you need to understand this part. I've explained it before, and I'm explaining it again. You need to understand this part. How the market comes and takes out this guy. When the market takes out this guy, okay, remember, before the market comes and takes out this guy, if you draw a trend line, then the trend line would have been broken already. Draw a trend line. This is the trend line, right? Look at it. The market breaks the trend line and then goes and take out the eye. If the market just break the trend line and the market doesn't take out the eye, this market will not buy. It will go and create a lower low. The key thing is taking out this eye. This eye is actually like your ABCD. So this eye is actually the new A that is formed for the market to do A, B, and then it will form C lower than the A. But now it did not form the C, it went and take out the A. Whenever the market takes out the A, there is a directional change. The market has changed direction whenever it takes out the. I don't know if it's making sense to you guys.
Yes, it does make sense.
So it's very important you understand this concept. Now, all this thing the market is doing rigmarole. See, all these things are just rigmarole. The next target of this market is this eye. And by the time it takes out this eye, the next target will be this eye. You understand? That's the way the market moves. If we keep doing it until we take out all the eyes, and then it looks to now start taking out the lows. That's the way it works.
Okay.
So the biggest problem that we have for us traders is we want this money very quickly, and this quickly is not
Because
quick for
sometimes
us.
it's going to go that high and then start going back.
Yes, Austin, I didn't hear you very well. Like all the trade entry I took last week, I left those trade entry and I'm still on those trade, right? Look at it. Those trades are still running. Now, see AUD USD. Let me come here. Okay, so let me do it this way. So this AUD USD, right? Okay. So look at what AUD USD is doing here. Okay, so now let me put down my system I was telling you about. So I'll put the 1 hour system now. So my 1 hour system, yeah. And then, okay, I'll show you something now. By the time I put this system. There's something you also need to know, and I think I've said it before, if you guys remember very well. Okay. Now, whenever, take note of this. This is very important. Whenever the market is trending, in a particular direction, and the market pulls back, okay, it's not going to be in any particular order, so don't quote me, okay? There is no particular order for it, but you must see your pullback must account for 3 candles. What do I mean by that? Look at this market. Now this market is selling, right? And then the market got here and started pulling back. This pulling back must account for 3 bullish candle, not in any particular order. It can be bullish, bearish, bullish, bearish. It can be bullish, bullish, bullish. It can be bullish, bullish, bearish, bullish. It can be bullish, 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 bullish. Okay? 3. Once you see 3 of this bullish candle in the pullback direction, the next candle that gives you a sell is a change, is a continuation candle.
Yeah, that's very true. I've noticed that as well.
Do you understand?
Consistently. Yeah.
As soon the next candle that shows you this market is selling, or the next candlestick pattern you see in favor of sell, after you have seen 1, 2, 3 bullish, is your entry to start selling. And vice versa for bullish. Okay? If the market is buying. So in this case, I can tell you for free that this AUD USD that you are seeing, it has done 1, 2, 3. And then it has given me 1 bearish candle. So my thought or my belief is that there's going to be another bearish candle that will continue this sell to the downside. That's my belief.
So one thing I noticed as well again too is the info board you gave us the other time.
Yeah.
You remember the info board?
Yes,
That shows you the trending, if it's a buy or a sell. Most often when it shows you, for example, a sell in the different time frame, let's say 5, 15, 30 time frame, all sell, or maybe even a 4 hour time frame or 1 hour, all showing sell. At the time they're all showing sell, it has given you those 3 candles already in the trending line direction. So jumping into it that it is a sell, it's in most of the cases I've realized that it doesn't work. The next thing you just see, it just goes into is it orange or so? And it's no longer selling anymore. So that's why I'm just concurring to what you've just said, that at least 3 candles, sometimes it might be 4, but at least when you see 3 candle, there is no point going in that direction anymore. You have to go the other direction. That's my observation I've noticed for the past 2 weeks.
Okay, good. So it's critical you understand this part, right? Most especially this pullback part. Minimum is 3. And then after that 3, you will not draw your counter trend line. But if you see my system, all that are already taken care of. Okay. As this market is pulling back now, let me zoom it out a little bit. As this market is pulling back, are you seeing this blue line? This blue line is my counter trend line. This blue line is my counter trend line. As soon as the market break below the blue line, it means the sell is confirmed. If you look at this one that is buying, this red line is my counter trend line. When the market breaks above this trend line, the buy is confirmed, and then the market goes. So for a long trend, for a market that trend for a long time, let's see S&P 500 for instance. Okay, for a market that trend for a while, you just want to see beautiful. So you just want to see this market. As soon as this market pulls back, okay, the market pulls back, you want to see that continuation. Okay, like in this case, you see the red, break the red, continue to buy. That's what you want to see. Okay, in most cases, you want to look, just be sure that your criteria that you set is met. Once that criteria is met, then you can take your trade confidently without stress. Okay. So everyone here, I charge you to go and develop a system, okay, that you can look at and you can say, oh, this market is going to buy. or this market is going to sell without too much hassle, without too much brainstorming. Okay.
Okay. Good evening, Patrick.
Yes. Good evening.
Okay. When you were illustrating how moving average one is equal to the candlestick itself,
Yeah.
you did mention of moving average 10 and 60, but you didn't conclude what it does for us. So can you understand that part?
Okay. So I was trying to say, let me just put some here. So let's go with moving average. So moving average 200. Let's say 200. Okay. I say 200 divide the market into buy and sell zone. Okay. Then I now come and say moving average 60. Okay. So moving average 60 is also, it's either you want to use 60 or you want to use 50. It's the same thing. The difference is not much. So if I put 50, you see that the difference is not much, right? So this 50 is regarded as a like a mid-term moving average. Okay. Every time the market pulls back to 50, the market tends to, extend. Okay. If you look at this 50, now so now let's remove this 200 so that there will be no confusion. Leave only the 50 or only the 60. Or let's put 50 and 60 if that's the case so that we'll understand it better. So let's put 50 and 60. So you can see the 50 and the 60, they are very close. So I use 60. Okay, but conventionally, I mean, in terms of Forex knowledge, 50 is the approved moving average, for what I'm explaining. So basically, it's believed that when the market breaks above 50, the market will naturally come back to 50. Every time the market move away from 50, the market will come back to 50. So when the market is coming back to 50 like that, you say the trend, it's more like saying that the trend is not very strong. Like you can say it's a weak trend. But when the market, let me see where I have a strong trend. Okay. So a good example is here. This movement, after the market hit this 50, this fall that you are seeing here is a strong move. This fall that you are seeing here is a strong move where the market don't have to start coming back to touch the moving average before proceeding. If it has to come back to touch moving average before moving, you say the trend is a slow trend or is a weak trend. But when it doesn't have to come back, you say it's a strong trend. So 50 is one of the moving average that gives you this indication. Okay, so when I'm developing my system, I use 60, I just want to have something that is fairly stable as compared to 50. So all those my system that you see, they are all 60. So for the weekly is 60, for the daily is 60, for the 1 hour is 60, for the 4 hour is 60. So it's just like saying uh, uh, you come to four. Okay, let me even do it here for you so that you see it. Let's delete this. I just want to use only the 60. I'm not going to do the whole exercise. So if we come to true TLMA, okay, I come here. I'll come here and say moving average 60. Exponential and say time frame. This is 1 hour. So I'll put daily first, 60. Let me make it 6. So daily, this is 60 on the daily chart. And then I'll come here, I'll say 4 hour 60. I just want to use only 60 so that you will see what I'm doing. Okay. And then I will now come here 30 minutes. 30 minutes 60. Okay. So now I'm not telling you that all these 60, okay, the one from daily, the one from 1 hour, the one from 4 hour, the one from 30 minutes, there's going to be a time when all of them will line up parallel to each other. Okay, when they will all be parallel to each other. I said when they are all parallel to each other like that, it means the market is trending. Okay, usually now if you look at it now, I didn't put all the other smaller value all the way to 20, so you may not see all that here. But if you look at it, you see the 60 of the 30 minutes. You see when it breaks the 60 of the 4 hour, and then you see when it's 60 of the 4 hour break the 60 of the daily. Okay. So based on this, it tells you the market is what? Is trending to the upside. So right now it's pulling back, and then the next thing you see is that it's going to reverse and then it continue to go up. Okay. So let's see it for something else. So let's see it for GBP USD. So for GBP USD, you see how the 30 minutes cross the 4 hour, brought the market down. And now you are seeing that the 4 hour is just about crossing the daily. So by the time GBP USD, if I if you had already tested it, okay. So we're probably going to likely see a sell, okay, in GBP USD, like I said before. So this your 30 minutes now is now acting like a trend line or a counter trend line to these two. So why this one is crossing and the market breaks below this 30, then you have a sell and the market will now sell in your favor again. Okay. Now look at where the three are parallel. So this is the one that I love most. I want to see where 1, 2, 3 are parallel to each other. This is parallel, parallel, parallel. You can see that it's a strong trend. Once you have the three parallel, that's when the market is actually trending. Okay, as soon as you have the three parallel like this. So this is what you want to look out for. But now it's very rare, to find when the three are parallel like this. Very rare because the market trend just 30% of the time. See another good parallel place. 1, 2, 3 parallel, and then you see all this strong move to the downside. Okay, let's see. So whenever the market is always pulling back to touch moving average before it runs, that is when you say we have a weak market. But if it doesn't pull back, it's just running. You say we have a strong trend. Okay. So if you look at it on my own system, you will see that it's more line up because what I did was to take from 60 to 20. I think I took 60 to 20. Let's see. So I did 60 to 20 for 4 hours, 60 to 20 for 30 minutes, 60 to 20 for 1 hour, 60 to 20 for daily, just like that. So if I come here, if you look here, you see that I separate them with moving average. So I start here with 60, okay, and then I end it with 25. So you can see, so I use 25. So in between 60 and 25, I have here, I think it's interval of 5, this thing. 60, 55, 50, 45, 40, 35, 30, 25. So that's why I did it. So you can also create your own moving average rainbow. You create your own. And when you create your own, trust me, by the time you finish creating your own, you will see that this thing works. Okay? You see that it works. Okay. Then another thing you also want to consider in this case here is this. Remember, we say the market, takes out. So this is a previous resistance. And then when the market comes back to this resistance, the market come back to this resistance, which is in this case here, the market gives you a candlestick and then a bought. Now the market came back now to this resistance, but this time the market breaks it. The market breaks this resistance this time. Now, so this is more like retesting, this resistance. These are the two components of this resistance. Is this candlestick and this candlestick, this bearish candlestick and this bullish candlestick. So if we go to the top of the bearish candlestick, which is the biggest among the two, you see that the market has not, broken above it. So if we bring it here, perfect. So you see the market, after the market break below here, came back to test, you see that it has not broken above it. So if the market breaks above it, it may just nullify all this analysis and then the market think of buying again. Or the market can come break it, touch the 200 moving average and then dive and start selling, which is what I think is what most likely going to happen, is that this market is going to continue to sell. So if you look at it, let's see, the market has pulled back. We've had 1, 2, 3, 4, bullish candle, and then a possibility that the market is going to sell.
Okay, thank you. Thank you, Sir Patrick. You are trying to explain it with this your system, and most of us are just using normal MT4 platform with the normal standard indicators. So in that case, if we want to build what
No,
is known as
see,
a
before I
copy.
explain, sorry, Amadi, before I explain with my system, I first of all did it with the standard indicator. I did it with the
Okay.
standard indicator first. So you
So what
can
I want to ask,
compare.
what
Yeah.
I want to ask, if you want to build a rainbow, just call it a copy indicator, or can we do it between the range of that 10 and 60, even if it
Yes.
is
Yes.
just between
Yes, you
10
can.
and between 10 and
Can.
60, we'll be able to get this directional move. I mean, a trend directional movement the way it appears in this
Don't
system.
worry. Let me just do one for you. So I come here and
Okay.
I say I'll use 60 and I use 60 as the biggest moving average. So I make this
Okay.
black. I make 60 black. I make 60 thick. And I say this is my 60. Okay. Now immediately
Okay.
after 60, I put 55. And I say 55 is white. And I change the thickness to the next thickness. Okay. I like using exponential. Let me switch to exponential. I prefer exponential to simple. Okay. So then the next one, I say uh 40,
You have done 55.
50. Okay. So 50, I say blue. I reduce this. Then I come to 45. And I say red. Then I come to, let me zoom it out so that you can be seeing it. Okay. Then I come to 14. And I say that golden rod. And I come to 35. Let's say still blue. Then I come to 13. Let's say gold. I come to 25. And let's say it's orange. Orange. Then I come to 20. Let's say white. Then I come to 15. Let's say coral. Then I come to 10. Okay, and I say it's Dodger blue. Okay, so now sometimes I do 7. I like 7. I like 7, but my 7, I prefer it when it's smoothed. Okay, let's see how it will be. So you can see the 7 smoothed is even bigger than the 10 exponential. Okay, so but let me just remove it. And let me just make it 7 exponential. All right. So now you have successfully built a trading system. Okay, this is your trading system. Let me compress it. This is your trading system. What it tells you, can you hear me?
Yes, I'm hearing.
Can every other person hear me?
Yeah.
Yes,
Okay,
you're
now.
audible.
So this is your trading system. Number 1, it will work on any time frame. Number 1. Number 2, you have a condition that you want the market to meet before you take a trade. Okay. So now, if you look at this, your condition now based on your system, based on this system, is the black line is actually your base. So anytime the black line is on top, it means that the market is selling. Anytime the black line is below, it means that the market is buying. Do you understand? So most times people
Yes,
want
sir.
to cash the trade from the beginning, but it is better. It is better you start seeing that this black line, it has crossed like now. It started crossing from here, and then eventually it started showing from here. So you may not be able to cash the trade from the very beginning, but once you establish that, hey, the market has crossed, the black line has now switched to the upside, then you now start looking for things like counter trend line break to start selling in favor of the black line. Just like what I showed you now. So if you are sold here,
Okay.
black is on top, market is approaching black line, and then boom, it breaks a counter trend line, the market starts selling. And that's all this drop, that you see. So it's just for you to set the condition and say these are the conditions that this market need to meet based on what I have put my moving averages, and then I will trade. Like I said, this thing is not rocket science. Anybody can do it. But preferably, instead of doing this on 1 hour, you can see that you have a better system or a better setting or a stronger trend on the 4 hour. Can you see that? On the 4 hour, can you see how the black line gravitate and break through all this and came out this other side? Okay. Let me compress it so that you see. See this black line cut through. So what some people do is, I've seen it before. That's a long time ago. One guy, he said, once this black line enters into this moving average, where you're not seeing the black line again, he said that is your entry to buy. So now maybe you buy the market here, and then the market run up and pulls back and then continue, you're already in the trade. Some people will not take it here. Naturally, I will tell you that when the market breaks above the black line, the lowest point before the market breaks above the black line is your A. And then when the market pulls back into the black line, pull back and start approaching the back line, from where that pullback starts is your B. Okay? And then you put your Fibonacci between A and B and start looking for a candlestick formation from this level. In this case, 23.6 is the level, or 38.2, and then it gives you a bullish engulfing candle, and then the market starts to buy in your favor.
Now the problem with those of us, the beginners, and with not so much big capital, to trade on 4 hours is quite boring, and even when you put your stop loss, if you the point where you put your stop loss and where you enter the trade, you can see that it's already a huge amount of money that you will be
Okay,
you won't be relaxed.
let me do something. Let me do something, Amadi. Let me save this system. Let me just give it a name. Just say this system 0. Okay.
If we can do this on 15 minutes or 5 minutes and it still works fine for people like us.
It works now. I just told you, I said this system works on all time frame. That's what I said.
Okay, sir.
It works on all the time frame. Okay. So now this system, I want to show you something. I'm going to put it on all the time frame for you. So I'll put it on daily, system 0. Oh, that place when I put on me go far. Okay. I made a mistake. Let's go back. Let me change the name. System 0. The 0 should come. What did I do? The 0 should come after rename. The 0 should come after the dash. Okay. All right. So I should be able to see it here. All right, perfect. So here is system 0. Here is system 0. Here is system 0. Okay, so make sure you grab me. All right. So now I just successfully applied this system to the monthly chart. Look at it. This is the monthly chart. This is the weekly chart. Okay. Weekly chart. Let me make it a little bit small. And then this is the daily chart. And then you have 4-hour charts. And then you have 1-hour charts. So I want you to see holistically what the market is doing. So which currency pair is this? AUD USD. Okay. So this is AUD USD. Now, Amadi, can you see what I've just done? You can see what I've just done, right?
Yes,
so
sir.
now,
yes, sir.
looking at this chart, you agree with me that the bigger time frame, the higher time frame is stronger than the smaller time frame, right? Now, this smaller time frame here is telling you that, oh, this market has crossed, is going to buy. But look at the big time frame. Look at monthly. The monthly, the market just hit the 60, and then it's creating a rejection from the 60.
Yes, sir.
Then look at daily. The market has already crossed the 60, okay, and even formed a support, probably maybe waiting for a possible test of the 60. Then your 4 hour is already trending with 60 on top, everything line up parallel. Your 1 hour has trended, pull back, everything line up, and then so your best bet to use the kind of system is you want everything to go in the same direction. So let's say this guy, this is S&P. So see your S&P. Monthly is a buy, weekly is a buy, daily is a buy, 4 hour is a buy. Come to 1 hour and look for any buy in the direction of all this buy. Are you seeing that? In that way,
Yes, sir.
you don't need to struggle to do this analysis. I just give you what I'm showing you now is a perfect trading strategy. No need to think too much. All you need to do is change your chart. I change to this chart. Is this one work? No. Change to this one. Is it working? No. Change to this one. You see, when I'm doing my analysis, I don't think. I just keep swaps changing. If I see trade, I trade. If I don't see trade, I leave it. You understand? Just keep changing. You keep changing until you see the one, that fits you. See, now this is a good one. Look at this one. This is a good one. This is USD NOK. Look at it. Monthly is a buy, weekly is a buy, daily just cross into buy. 4 hour has been buying. 1 hour is telling you we are buying, but it's pulling back. So when this 1 hour changes direction to face the direction of all of them again, that's when you take the trade. When this 1 hour give you a buy now, you start buying. See Ethereum. Look at Ethereum. I'm on Ethereum. Look at this Ethereum buy. Okay. This is even very early. This entry is very early. And I left it because I just felt it's going to go, go further because of the 4 hour A, B, C, D. Okay. So I just left it. It's going. Look at Bitcoin as well. No, not Bitcoin. Avalanche is Avalanche. Avalanche, where are you? 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 Avalanche. Look at Avalanche. Avalanche to buy. You see, these are market that I expect. Look at this is daily. Daily give you A, B, C, D. A, B, C, D. You have done the first A, B, C, D. Then this is A, B, C. It's going to the next D. Okay, so it still has a long way to go. Okay, so now I just gave you a trading system. Everybody on this class, confirm you can do this. You can create this system yourself on your chart, just like I did it now.
Yes, I can. Yes, I can.
Yes, I
can.
can. Yes, I can.
And once you're able to create this system,
okay.
you've solved practically your entry, decision to enter the market. Here is gold. Let's see what gold is doing. Gold, yeah, look at gold buying massively. See this massive buy. Look at it. Monthly is a strong buy. Look at this monthly now. Watch this. See where this monthly pulled back and came to this 60. Can you see how the market just gave you a bullish engulfing monthly candle? This candle alone, let me show you this candle on 1 hour. I won't be able to see it on 1 hour. Let me show you on daily. On daily. On daily is a lot of movement. Okay, see what I will do. Let me switch daily to monthly and then put a line on that candle. Okay, so we'll put a line at the top and the bottom of this candle. Yeah, and then you switch it back to daily and then compress the chart. Can you see where are you seeing where the market bought from? Look at it. This thing that you are seeing here, 9 this. That is, if you have taken the market anywhere from here, buy, you would have made 9,467 pips in the last 477 days. That is one whooping 1 year plus. Remember, 1 pip in gold is $50. So $50, $50 $50 times, what did I say? 9,000 what? 9,467. Let's say 9,467 pips. So if you have used one lot to enter this trade from that place I just showed you now, which is more than 1 year ago, you would have been netting $473,000 as of today.
Great.
So if we divide this by 12, let's say monthly, this is a monthly earning of around $39,000 every month.
Jesus.
And this is for only gold. And remember, anything gold is doing, SAU EURO does similar thing. Look at it. So as you took that trade on gold, you will also take it on SAU EURO. Are you seeing it? The same volume, I'm sure, I think it's on SAU EURO dollar per pip is higher than that of gold. Okay. So why gold is doing 50, I think this guy is doing between 60 and $70 per pip. Okay. So if you are just taking only these two trades, you would have been netting close to like $80,000 every month.
Jesus.
So these are the possibilities in this market that people are not aware of. And they happen. How do you explain? Let me take it back to that gold. All you need to do is just to see this candle. Look at it. This candle actually closed before you took the trade, because the close of this candle is all this area that you are seeing now. Okay. This candle completely closed. As it's at the close of this candle, you took the trade. And then you sit in your house, you go to your business, you go to your work. Every day you come, you see the market is still running in your favor, it's still running in your favor. As we speak right now, the market is still running in your favor. And then even as this market is going like this, you can come to this 1 hour, okay, and be buying additional trade with every pullback that you see. The market pulls back, look at it, when the market gets into this area, break below this low, this candlestick, and you know that the monthly is still buying, you know that the weekly is still buying. And then if you look at this 1 hour, this market, none of this line has broken across the black line. It tells you that this trend is still effective. So what you will do, look at the lowest point the market got to, draw a trend line from the top and let it touch the last resistance before the last support. You see how the market breaks it, it came back and tested it, and then the market shoots like a catapult. Guys, you see this thing is 100% real. Even this 4 hour that pulls back like this, all you need to do is just to put your counter trend line on this 4 hour like this. And when the market breaks this trend line, test it, you run with this profit. So even maybe this is your first trade that you enter, you can keep entering more position as the market is going.
Okay, Sir Patrick, thank you very much. This is well understood and very quite interesting. Can we use with this system now? can we use 1 hour time frame as the largest time frame and then go down to 5 minutes, five frame and be, entering and exiting?
It's very simple now. I change this one to 1 hour. I change this one to 30 minutes. I change this one to 15 minutes. I change this one to 5 minutes. And I change this one to 1 minute. Chicken, this is what you want to see. Case closed.
Yes. Okay.
So your 1 hour is buying. You look at your 30 minutes. You look at your 15 minutes. I don't like doing 5 minutes and 1 minute. I'll rather stop at 15 minutes. Okay.
Okay.
But this
That's
15
also
minutes,
interesting too.
this 15 minutes has to be going in the direction of both the 30 minutes and the 1 hour. And then you are good. So like all this, like this pullback you see on this 15 minutes now, you may not see it on the 1 hour. It's not clear, it's not very visible. But on the 15 minutes, you see it. So you see this buy is a continuous buy.
Okay. So let me then stick to 15 minutes then for day trading.
You too like quick money, 90, 90
The money no plenty now. You know
See,
plenty.
it's not a matter of money plenty. Let me explain to you. Let me explain something to
Okay.
you. Okay. I can trade from any time frame. I trade from monthly, I trade from weekly, I trade from any time frame. Don't deceive yourself. Listen, see this place, see this value. Look at this value, 2722. If I switch this thing to monthly chart, if I switch this chart to monthly chart, it doesn't change this value. I don't know if you understand me.
But it affects where you put your stop loss.
It only affects where you put. See, listen. You can take the trade from monthly chart and set your stop loss with 1 hour chart.
Okay.
Do you understand?
Okay. Yeah, that's also understood.
So don't kill yourself. Say, oh, na 1 hour. No, it
So
doesn't matter.
how do we then take care of the news? That's the other thing that can take it off.
So that's a beautiful part of trading from the higher time frame. When you trade from the higher time frame, the effect of the news is not felt. You don't even know that there's a news. It's not your business whether there's a news or not. You understand? It's not it's not a factor. Remember the technical, and that's where a lot of people are getting it wrong in this forex trading. The technical is actually what rules the market, not the fundamentals. The fundamentals, they are just, in fact, according to MTI, he said the fundamental exists to fulfill the Fibonacci sequence faster. That's why the fundamental exists. And honestly, that's the entire truth. Like this market now that is buying now, all these big candles that you are seeing, sometimes they are fundamental. 90% of the time, the fundamental will go in the direction of the trend. 90% of the time, go and check. All these big candles you are seeing, a lot of them are fundamental announcement on the monthly chart. Look at it. Those giant candles you see on the monthly chart, a lot of them are fundamental announcement. Why didn't the candle now came down? Why didn't it come against the trend? The trend say buy. And you see the giant candle are going in the direction of the buy. And a lot of them are fundamental announcement. So it helps to fulfill the Fibonacci sequence faster. See like this month now that is going, you already see that everything is lined up. And then you saw that this place is a resistance. You put a line here. And then the market came and break above this resistance. What are you waiting for? If I want to even buy this market, I will buy it from the close of the bearish candle. When I want to buy, I try to buy from bearish and sell from bullish. Like when this market formed this support, and then it came and formed this resistance, your best entry is the close of this bearish candle. You buy it from here, and the next candle that comes is a massive bullish candle in your favor. The same thing here. Equal open and close, equal open and close. Buy this bearish candle, the market goes in your favor. Guys, this is 11. We have to close the class. Okay.
Thank you very much. Thank you very much. Thank you
So
very
I
much.
just
God bless
try
you.
to, because I really want to see, that guys in this group are able to do this thing by themselves. I want to see, people posting, attempts to trade, and they are actually trading and they are making profit. It makes sense. It shows that, oh, the knowledge that I have acquired is producing results. Okay. And like you all know, Musa shared this thing the other day on his FTMO challenge. You can also go to FTMO, create an account, and be doing the trial. The trial is 14 days. Just keep doing the trial, use it to perfect, your hand, and then you go for the real challenge. Because you see this work that we are doing today, your work can be that you are an FTMO trader. It's a job. It's a full-time paying job. You can sit in your house and be trading for FTMO. You make profit, they give you 80%, they take 20%, and you are trading on a big account. It's not compulsory that we must use 5 to 8 job to hammer. You can use your Forex to hammer. Okay. Then you mentioned the Guppy moving average, right? So if you have, I don't know if you have the indicator. Okay, just type Guppy. So I have the Guppy long, I have the Guppy multiple, and then the Guppy short, and then I also have the Guppy trader. So if this one, if I just come here and say plain chart, right? I just drop the Guppy. If I drop the long means that I want to be looking for buy opportunities, right? Why the short means I want to be looking for short opportunities. Okay. And then if I remove this and put the Guppy trader, the Guppy multiple moving average, is a combination of both long and short. So once you put this, it gives you both long and short. So if you zoom it out, the interpretation is this short, this is the short, this short is a pullback against the long. The long is the trend. This short is the pullback. When the market pulls back and then the market breaks above the short, it's a continuation trade. Keep buying. Can you see that? So at this point, the market is coming short, 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 enters into the long, and the next thing, boom, you see a reversal. You take a trade, and then you run with all this profits. This is 1 hour now. This is not, and you can do it for any time frame. It doesn't matter. This is 30 minutes. Okay. It doesn't matter. It doesn't matter the time frame that you are in. This is 15 minutes. So this is just applying the Guppy long and short directly to your chart. Whether 1 hour, whether 15 minutes, it doesn't matter. You see the market came all the way to the Guppy long, and then it broke the short. So yeah, you take a buy from here. You buy from here, the market run up. You buy from here, the market runs up. Okay. So every time the short pulls back into the long and gives you a reversal, it's an opportunity to continue to trade.
Is it a paid indicator?
No, it's not paid, it's free. Just type it on Google, you see it, download it and put it on your chart.
So what did you call it again?
Guppy long, look at it, Guppy underscore long, Guppy underscore short, Guppy underscore multiple underscore moving averages. Any of them. Then the Guppy, I also have the Guppy trader, it's just a line. The Guppy trade, let me see, Guppy trader is just a line. Yeah. So that's the Guppy trader. It's just a line, one single line. So all these templates, you'll be able to create all these templates yourself. Like you see here, I have several templates. These are different templates, for different purpose. For me, I did them for different time frames. Okay, and then I have one that is specific to all time frames, like this one. I can use this for all time frame, whether 15 minutes, whether 20 minutes, whether 10 minutes, any time frame, it will work. Okay. So this is for all time frames. Okay, so I can decide to switch it to 30 minutes. Okay. I can decide to switch it to any time frame of my choice. Okay, it doesn't matter. So just like your goopy longer chart. So these three white lines that you are seeing, they actually represent moving average 200, 150, and 50. Let's see. 200, 150, 50. When they are line up, you know the market is trending. But you see, when they pull back into the system, and then all of a sudden the market breaks above all of them, as against breaking this black, that's your continuation trade. That's this buy that you are seeing now. So like this, they came back here, and then boom, that's this buy. It came back here, boom, that's this buy. So you can do that. Okay, and if I switch this same guy to 1 hour, you see how it looks on 1 hour. Okay, and then if I switch it to 4 hour, you see it's a massive long trend. And if I switch it to 1 day, that is that's the father of them all. You see? Okay. Thank you everyone for your time. Hopefully we'll connect again. But please let's go back and make use of this fact. If you don't do anything, please do this one. Make sure you do this one. Even if you don't do anything out of all the things that we have said, make sure you do this. I like doing monthly, weekly, daily, 4 hour, and then 1 hour. Make sure you do this. Set your system like this. It's not difficult to set it. All you need to do, just open all the time frame, bam, 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 open all the charts down, and then come to window, click on time window, and then you see it like this to appear like this for you. Open 4 different this thing is easy. Come here. If I come here now, click AUD USD, you see a new this thing. If I come here, click another one, USD card. Once I come here and I click tie, I can tie there, or I can just come here window and I say tie window. You see, it has arranged everything for me. Now I don't need this two. I close this, and I come here and say tie window. It will arrange everything for me. So you can do it. It's no rocket science, right? The only difference, the
Thank
only
you,
thing that
sir.
you may not have is
It's
this
one
indicator.
of the best lesson I have had today. Honestly, this is quite interesting.
Very good. It's
God
nice to
bless you.
hear that.
Thank you so much.
All right. Thank you, everyone. And let's have a wonderful
Thank
night
you.
rest.
Thank you, sir.
God bless you.
All right. God bless you too.